talk about appraisal. You need to know the difference between real estate, real property, personal property, and intangible property. So real estate is the physical thing. It can't be appraised or sold. Real property is the rights in realty, basically the bundle of rights. Personal property is anything that's tangible, but is not attached to the real estate in a permanent manner. And intangible property consists of those non-physical assets. So we have to think about the difference between real estate and personal property. Here's a list of different items that might be considered either. So looking at all of these, we have a small shed that maybe you would buy at Home Depot or Lowe's. Would that be considered real estate? Probably not, because it's not attached in a permanent manner. Overhead crane. Those cranes in industrial buildings might be 10 tons or 20 tons. And in my experience, it's generally something that's going to transfer with the property. So that would be real estate. Machinery and equipment in an industrial building, personal property. Window air conditioning unit, that's personal property as well. Manufactured home, that is something that could be moved. You can attach it to a truck and pull it away. So those two would be personal property. And then we have street lights, signage, those two real estate, and a desk bolted down in an office. Again, a little gray area, but personal property. So here's the difference between the two. You can move personal property, it's not attached. Real estate is. I've provided a separate video specific to the bundle of rights and the powers of government, but it's important to go through these specifics again, certainly about public restrictions on ownership, but we're also going to discuss some private restrictions. So we have taxation, eminent domain, police power, and a sheet. What do they mean? Taxation, that's where the government's raising money through assessment. Eminent domain, where the government's taking property for public use. Think about expanding a road. They're giving the property owner just compensation for taking that property. Police power, these would be things like zoning. In a sheet is when a property sells where there is no will or heirs. The government can take that property, the state can take that property. So we have an easement. What's an easement? Basically the right to use another person's land for a stated purpose. Here we have various types of easements. Probably have seen many of these before, but I'm going to go through them and give you examples of what each of them mean. So we have affirmative easement, where one property owner is allowed to maybe discharge water onto another person's land. A pertinent easement, where a property is landlocked and a property owner is giving somebody access. Conservation easement, we've heard about this a lot in the news and on various publications about where conservation easement is placed on the land and it is no longer, you can no longer develop it. Easement by necessity, where an owner splits his property and one of the parcels is landlocked, but that one owner is giving access to it. A easement by prescription, someone uses part of your property without permission. Easement in gross, the most obvious here are utility companies that have easements for sewer lines and utility lines and cables and whatnot. Negative easement, can't block somebody's view by constructing a large fence. And preservation easement, that's when you are protecting an historic property. So why are appraisals needed? Here's some of the various reasons that appraisals are needed. The most obvious is financing, when somebody is buying a property and they're trying to secure financing to buy it. But there are other reasons for appraisals, and we're going to go through some of these reasons later as we go through. So under purpose of the appraisal, the first thing we need to do is define the value that's being appraised. Is it fee simple or owner occupied, or lease fee in which it would be leased to others? Appraisers need to know what the intended use is and the intended user, the date of the value opinion or any assignment conditions. The date of value opinion can be as is, market value as is, or it can be a value in the future, a prospective value upon completion, or maybe a prospective value upon stabilization. The difference being upon stabilization is when a property reaches stabilized occupancy. So these are different types of value opinions. We also have assignment conditions where we might add an extraordinary assumption saying we assume the property will be built in a certain way. And then we have various property characteristics as well. So who are the people that need appraisals? Here are some of the different users of appraisal. And you have to think about an appraisal as being a tool for somebody to make a decision. That decision might be to settle an estate if you're an attorney. If you're a lender, to secure financing. Maybe that appraisal is being used for a relocation company, or accountants are trying to determine what fair value is. Government agencies, VDOT, we just talked about that, where somebody is taking a parcel of land to expand a road. And then finally, we have private individuals, where they're trying to make a decision on whether to buy or sell a property. So under scope of work, this is really important because we need to know what we're being asked to do. What is the level of detail? Is it going to be a narrative report? Is it going to be an oral report? How are we going to plan to do the appraisal? What will we do? How much research will we put into it? Are we going to do an exterior or just a interior and exterior inspection? So the bottom line here is, if you do what you say and say what you do, you're fine. So the process here is collecting the data, analyzing it, coming up with your conclusions, and then completing the report. Here's the valuation process in a nutshell, this flow chart. So under the identification of the problem, we are dealing with our intended user, our intended use, the type of value, the effective date, and any assignment conditions. Under the scope of work, we've talked about that a little bit, and we're doing what we say and saying what we do. Under the data collection and property description, we have our market area data, our demographics, inventory, and vacancy. And we have general characteristics of the region, the city, the neighborhood. Under subject property data, we have our legal, economic, and physical components, our specific characteristics of the land and improvements, and here we identified whether we have personal property included. When we're dealing with our comparable property data, we too have comparable sales, we have listings, we have offerings, we have inventory and vacancy rates, we have cost and depreciation comparables. Sometimes we'll have income and expense comparables, and we will have capitalization rates that we will either get from sales or publications. In the market analysis, we use supply and demand studies, we use market studies, we use marketability studies. This falls under data analysis. In the highest and best use section, we will analyze the property as though vacant and as improved. When we get to this section of the course, we will certainly identify the differences between the two and what goes into it, but basically what we have are four characteristics. We have legally permissible, physically possible, financially feasible, and maximally productive. When we get to our land value analysis, here we're going to look at comparing sales either through allocation, through extraction. We can also use a subdivision analysis or ground rent capitalization methodology to come up with our land value. And then we have our approaches to value, our sales comparison, income, and cost approach. The sales comparison is basically buying an existing property using that principle of substitution. Cost approach where you buy a piece of land and construct a building to your specifications. And we have the income approach, which is based on a lease or if you're renting a property. And finally, we have to write the report. We have to report it in a defined value and write it. So let's talk about Chapter 2, land, real estate, and ownership of real estate, real property. So we have the concepts of land: geographic and environmental, legal, economic, and social. What do they mean? Well, under geographic and environmental, we see here that each parcel is unique and that supply is finite. A little while ago, we talked about highest and best use, where we have to determine whether such factors like location, zoning, traffic counts, topography, things like that might impact the land. Under legal, we have zoning, we have proffers, we have overlay districts. Sometimes we'll have property that have historic overlay districts or something that may prevent certain uses. We have to look at that. Economic, here we have the bundle of rights where we can lease a property, sell it, develop it. Under social, we know that land's fixed. We know that in densely populated areas, land use and safety regulations and other social controls may affect the behavior of particular buyers and sellers. So most of the appraisals involve privately owned property. We have different types of ownership: joint tenancy, tenancy in common, tenancy by entirety. Here the definitions are shown for each. Let's talk about the nature of value. With the classical school, we have challenges to the classical school, which form the neoclassical, and then where modern appraisal theory was developed. So under the classical school, this is where the four agents of production, land, labor, capital, and the agents of production were established. Here are the two challenges: Karl Marx and the Austrian school. Neoclassical merged the two, and then modern appraisal theory was formed by Alfred Marshall when he wrote Principles of Economics in 1890. Here is where he first identified the three approaches to value: the sales comparison, cost approach, and the income capitalization approach. We have four factors of value: utility, scarcity, desire, and effective purchasing power. Under utility, something will have value only if it's useful. Scarcity is the basis of demand. Desire, if something is not desired, then you really don't have any value. And effective purchasing power. Example being a $2 million house in an area where the median household income is only $50,000. Well, that you don't have the effective purchasing power to buy that property. So demand's created by the four factors of value. But entrepreneurs create that supply to satisfy the demand they have. So appraisers must read the market and understand supply and demand. Understanding supply is easy. You can get that information from various publications, but demand is kind of where appraisers fall short. It's more difficult to determine where demand's coming from. It's more difficult to determine when a market becomes saturated and there's not enough demand for it. So we need to talk about the different types of terms, these being very important. We have price, we have cost, and we have value. You see the difference where price is the actual amount paid in the real estate transaction. Cost is what the dollar amount required to build something, and then value describes its worth. We have different types of value: market value, insurable value, investment value, prospective value, retrospective value. There's definition of market value. Market value is required in all appraisal reports per USPAP, Uniform Standards of Professional Appraisal Practice. So you still need to provide an as-is value every time we appraise something, even if the likely use is something in the future, a prospective value. So We have to understand the difference between market value and what may not be market value when we're doing an appraisal. So here are the conditions that must be met by both buyer and seller. Have to be typically motivated, have to be acting in their own best interest, has to be exposed to the open market based on a reasonable time frame. That time frame could change based on different types of markets. Payments in cash or something equivalent to it, US dollars. And the price is unaffected by any special financing, creative financing, or concessions, inducements, things like that. Anticipation in change. So the present worth of future benefits, where anticipation creates demand and value. Real estate, we understand that real estate markets change constantly. Everything is cyclical. This anticipation and change is the basis for the income approach. Here's an example where you're not going to pay for your mobile device only has value if you're able to use it. If you think it's only going to last for a certain period of time, you're going to pay less for it. Same thing with real estate. We have to recognize when the market's changing. It's going to change, and we have to try to stay ahead of it. But the difficulty here is that we're basing our estimate of value on something that's happened in the past. So we have to be forward thinking. We have to recognize changes in the market. We have to understand what those changes are. Here's an example of how supply and demand controls price in overbuilt markets and in declining markets. Here's an example of competition and its source of value. So we need substitution in an open competitive market. So which is slower to change, supply or demand? It's supply. Demand can change quickly. What are some of the factors that make demand change? Interest rates, demographics, maybe a larger employer closing a plant in a small town. Let's look at balance or equilibrium and other externalities. So we have contribution, surplus, productivity, and conformity. So some things under contribution, some things add value, others don't. But the market decides in an appraisal what adds value and what doesn't. Under surplus productivity, if value is greater than cost, surplus productivity goes to the land. Conformity, optimum value achieved when property conforms to demand of the widest market. So unique properties may have value to one person or one investor, but not to another. And then externalities. We have things that would affect value like interest rates, tax laws, things like that.